Life is all about choices and decisions. And these choices change over time. When I was young, for example, I would splurge on all sorts of impulse purchases, then, realized only later that I didn't really need that 10th pair of shoes that I bought on a sale. As we grow up, we begin to focus on our family and bigger necessities like a home. And finally, when we're ready to retire, we want safety and comfort. So just like our priorities change over time, our financial decisions are different at every life stage, and so are our risk-return objectives. Hi everyone, welcome back to Mind Over Money. I'm your host Sumaira Abdi, and today we're talking about a question so many people have. How do I know which fund is right for me? Whether you're a new investor or just looking to switch things up, picking the right mutual fund can feel a bit overwhelming. But don't worry, here are some basic guidelines which can guide you to make that decision. Step 1 is ask yourself a few questions. Before you invest, take a moment to do a quick self-check with these questions. First, what's your goal? Why are you investing? Is it for something big in the future, like say a retirement, or maybe a down payment for a home, or your child's higher education? The second question you want to ask is, how long do you plan to invest? Are you thinking short-term, like a year or two? Or are you looking to invest for a longer period, like say 5 or 10 years? Consider here your current age as well. The third is, how much risk are you willing to take? Are you okay with some volatility affecting your investments at certain times if it could better the potential returns over the long run? Or do you want something more relatively stable, even if it means lower returns? Your answers to these questions will help narrow down the type of mutual fund category or scheme that's best for you. Step 2 is picking the right type of mutual fund. So there are 5 main types of mutual funds. The first of these is equity funds. These are for people with long-term goals like, over 5 years or more. Equity funds invest mainly in stocks. So they're risky, they're volatile, but they have the potential to offer higher returns over the longer time period. So if you're younger and or have higher risk tolerance, you could consider these funds. The next is debt funds. These invest in debt and money market securities. Unlike equities, here you earn through fixed coupon payments. And because of this, they are considered relatively more stable. Debt funds are great if you have a somewhat shorter term goal, like needing money in the next 1 to 3 years. The category is expansive. On the one hand, you have liquid and overnight funds which take care of your liquidity needs. And on the other hand, there are long duration bonds which can help you as an alternative to traditional investments with relatively better returns. They have relatively lower risk, and so they tend to give potential returns. Then there's hybrid funds. Hybrid funds are a mix of equity, debt, and commodities like gold, silver, and so on. They offer the potential of growth with a little bit more stability because of the diversification offered. They are good for medium-term goals like 3 to 5 years, or for people who want a blend of various asset classes in their portfolio. Hybrid funds can offer a balanced approach with relatively moderate risk. Passive funds. So if you like a low-cost, hands-off option, you might want to consider passive funds like index funds, exchange-traded funds, or fund of funds. These funds aim to track a particular market index and replicate them, so they're easy to manage, and typically they have lower fees. They can work for both long-term and short-term goals, depending on the index that they follow. And finally, solution-oriented schemes. Solution-oriented funds are designed to provide long-term wealth creation with objectives of retirement planning and saving for children. These funds typically have a lock-in of 5 years. The third step is to find funds which are suitable for your age group. Let's now take a look at some general guidelines based on different age groups and life stages. So, when you're younger, in your 20s or 30s, generally you have a longer investment horizon. This means you might be able to handle some amount of risk. Equity funds or growth-oriented hybrid funds could be a better fit at this time. In your 30s and 50s, you may have bigger financial goals like saving for your children's education or buying a home. So a mix of equity and hybrid funds could help balance growth with stability. Also, shorter-term debt funds can be used to build a corpus for emergencies. In your 50s and beyond, as retirement gets closer, you may want to focus more on preserving your capital. So debt and hybrid funds could be good options here. They offer a steady income with relatively lower risk. However, at this age, you can still choose equity funds if your risk-taking appetite is higher because of your income or other lifestyle situations. The fourth step is choosing a specific mutual fund scheme. So once you know which type of mutual fund scheme or category is right for you, it's time to look deeper into that scheme. First, you look at the fund fact sheet. A fact sheet gives you a snapshot of the fund's performance, their holdings, and also key details for all the schemes of that mutual fund house. It's available on the website of all the mutual fund houses and is a quick way to get an overview. Also, you can read through the e-scheme information document or the SID, which provides everything which you'd need to know about the scheme that you're about to invest in. So let's wrap this up and say that when you're choosing a mutual fund scheme, start by understanding your financial goals, your investment time frame, and your risk appetite. Then you need to pick the scheme type that matches your needs the best, whether it's equity, debt, hybrid, or passive. And remember, as you go, check the fact sheets of your schemes to ensure that you have made a prudent decision and that you're staying on track. Hope this episode gave you some practical understanding of how to choose the right mutual fund scheme for yourself. Remember, investing is personal and there is no one size fits all. So take your time, stay informed, and make choices that align with your goals. If you like this podcast and you want to be reminded of our future episodes, then do subscribe on all your favorite audio platforms and also follow the SBI Mutual Fund YouTube handle. I'm Sumera Abdi, and I'll see you again soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.